Hello everyone and welcome to this session of the A4S Summit. My name is Pablo Baruti and I am the founder of Altiorem, the world's first community-built sustainable finance library, and we'll talk a little bit more about Altiorem in a moment. But I also want to introduce my co-presenter, Abby Wild, who is with the Monash Sustainable Development Institute. And today we're going to be covering what we both think is a fascinating topic, is what are some of the behavioural and mindset issues which are really holding back sustainable investment and are essential really to get us to that next stage of our industry playing its full role in the sustainable development challenges. Now, you'll need to bear with me as I just share my screen. Hopefully you'll all be able to see that now. I also, really importantly, coming to you from Australia, want to acknowledge the traditional owners of the land where I'm standing, which is the Gadigal people of the Eora Nation and their elders past and present. So, as I mentioned, Altiorem is a sustainable finance library. Our mission is to support people who are advocating for and implementing the changes needed to bring about a sustainable financial system. And the way we do that is by summarising, collecting and categorising leading research and tools which help build and support the ethical case, the business case, the investment case and the economic case for sustainability, and also the tools that help implement those changes to make it a reality. To us, as I'm sure to many of you who are tuning into this, that the case is very, very strong, overwhelming indeed in my experience of about 15 or so years working in this area. But there are still some limitations to the way that we're operating, and that is what we're looking to talk about today. In addition to my role at Altiorem, in the interest of full disclosure, I'm also an investment specialist with a fund manager called Stewart Investors Sustainable Funds Group. This presentation is not in any way related to my work with Stewart. It's very much from Altiorem. So, with such a strong case for sustainable investment and sustainable finance, we want to put forward the proposition that an optimal investment strategy should achieve its investment objectives while also supporting, enabling a flourishing, equitable and healthy environment, society and economy. Again, to me and perhaps to many of you, that seems like a rather obvious statement, but again, it's not necessarily the way that we operate today. Before we talk a little bit about how we operate today, we need to recognise that the sustainability challenge is much more than a financial one in terms of traditional concepts of risk and return. It's existential. And there's different ways that you can look at this, and many of you will be well informed, having been to many of the presentations during this summit, of the challenges we face. But just quickly, this brilliant chart from the Global Footprint Network, which maps human development on one axis and the number of Earths that it takes to support that level of human development on the other. These are all countries, the small dots. And our goal and our challenge is to get down into that bottom right-hand corner, that square, where our environmental footprint is low, but our human development is high. So I think that's a really powerful way to really think about the sustainability challenge we face. Another way to look at it is through Kate Raworth's donut economics, and it's looking really at an ecological ceiling or planetary boundaries and a social foundation. And so our objective really should be to be within the donut, and as she calls it. And unfortunately, as it stands today, we're in breach or in shortfall of many of those boundaries. So it's not just climate, of course, biodiversity, land conversion, and pollutants in the environment. What does this matter to finance? Well, both the Sustainable Development Goals and the Paris Agreement, as you would all well know, call out the finance industry specifically to say that it's essential that private capital moves in a way that supports the transitions that we need to get into the donut or to have that safe operating space for humanity. But as it stands today, and we'll talk a little bit about the growth of things like responsible investment in a moment, the shortfall is very significant, $2.5 to $3 trillion a year, according to the UN, while coal-fired power stations and other climate unfriendly energy sources and technologies are still attracting investment, with, since the Paris Agreement, almost $500 billion going into coal-fired power stations, according to the UN. We're also seeing that actually investment in SDG related infrastructure was lower in 2018 than what it was in 2012. So there's something missing, and there's clearly a gap that needs to be filled. Many of us in this industry, in working in responsible investment, would feel very strongly that this is the RI, and the way that we do it is part of the solution, and it's been growing rapidly, 26% growth over the last 2 years, according to the Global Sustainable Investment Alliance, whereas total, but still a relatively small proportion of total non-bank assets, which were growing slower at that point in time. So in, arguably in 13 years at those rates of growth, all investment will be responsible investment. But importantly, we need to recognize that not all responsible investment is all that responsible, really. And so we have two different ways of looking at that. One is from the Australian Responsible Investment Association, RIA, and in it benchmarks the performance of self-declared responsible investment managers across the Australian market. And it finds that those with leading practices, which are the green bars in the chart, is still a minority of all managers. And you can see as the in terms of that lowering of scores, that some have very low scores indeed. Another way of looking at it is from the UK's Share Action Group, who looked at the largest 50 asset managers globally and rated them on a range of responsible investment criteria, and tells a really similar story in that the majority still has really poor responsible investment practices. So we need to both grow responsible investment, but we also really need to improve responsible investment. So one of the things that we would like to point out today is the mindset issue, and how we believe that it can be one of the issues that are really holding back both the growth and the improvement of responsible investment. But to explain it well, I think we're going to turn to Larry Fink, who's talking about in an interview he did earlier this year, might have been last year actually, sorry, last year, the letter that he wrote to companies on climate change and the various changes that Blackrock were making in relation to managing climate risk across their funds. So here's to Larry.
Do you believe the science? I believe in the science, but I did not write it as an environmentalist. I wrote the letter as a capitalist, and my job is as a capitalist to help prepare our clients for the redistribution of capital, and more importantly through that is to provide them with an investment portfolio that will outperform.
Now, outperform, let's focus momentarily on that, because one of the things that we want to talk about and
do you believe this?
Is what we talk about in terms of performance as it relates to financial investments. And so many of you will be familiar with the efficient frontier and the idea that for a given level of risk, you can achieve an optimal amount of returns, or vice versa for a particular desired return. You can do it for the least risk possible. You'll notice, of course, that those two dimensions don't incorporate directly and even quite vaguely indirectly the types of challenges that we spoke about earlier when we were looking at the donut and the global footprint chart. How do we as an industry know that we're doing well when it comes to meeting the efficient frontier, or hitting the efficient frontier? As it were, we use benchmark and indices. And again, here's something from the CFA Institute in the UK in why that they're important, and there's no doubt that we do need to monitor performance and the ways that they're used in terms of goals and objectives, helping us with our risk appetite and our willingness and capacity to accept periods of underperformance if the goal is being achieved. So they play an essential role in the way that the performance of institutional investors is judged. How they comprise, though, again, a bit like the efficient frontier, broadly collection of assets, a basket of assets, often by their size and their current share price or bond price in terms of their weighting. And so, again, being able to tease out the relevance of those issues, the great sustainability challenges, be it climate, biodiversity, pollution, human development challenges, is difficult again. These are, of course, the issues that all of us attending this conference are very much interested in seeing resolved, and the UN Sustainable Development Goals have achieved enormous amount of penetration across our industry and acceptance amongst the industry of being something desirable that we should be striving for together. However, those traditional ways of thinking about risk and return and the focus on risk and return is it doesn't really capture these types of objectives. And the argument that we're making today is that this holds us back, that where we see our duty and our responsibilities as financial industry as risk and return only and delivering risk and return only, that will alter our perspective of what's possible and consequently our actions, and some of these goals will be out of reach. Just to I guess reinforce the point that Larry Fink was making around the focus on risk and return, if you think that's actually not the way we think, here is David Neal, CEO of IFM. Now, I don't know Larry Fink or David Neal, and none of this is intended as a personal criticism of them. These are interviews which actually, in my experience, reflect broadly what many in the industry see their roles as. And so let's hear from David.
And so do you see it purely through a financial prism, say, rather than an existential prism, which is what the former BHP CEO sees it as?
Well, look, I think those two things are really closely related, aren't they? You know, if there's an existential risk to the planet, that's going to have financial consequences. So I think it amounts to the same thing. But I guess my task, what I've been asked to do by our investors and the members of the super funds, is to generate strong returns. I haven't been asked to save the planet. Now, it just so happens that that I think it's really important that we help manage the risks of climate change to generate those strong returns. So I think the two are closely aligned.
So, and I think that is a fair point, and many in the financial markets would agree that as a risk and a threat becomes existential, then clearly there's going to be financial implications. But some of the questions that leaves me with,
and so do you see,
excuse me, is what then of an issue before it becomes an existential risk? What is the relevance at that point? If the speed of change is required is much faster than what the market or peers are moving, what then? Because the science of climate change, as an example, has been well established for many years. And some of the other really important points for those of us who want to see responsible investment grow. What if it's not an existential risk, but it's still a great harm that's being caused by an investment on people or a local environment, for instance, or if those are externalized? So one of the overarching questions that watching David's interview left me with was, if we take that approach that we are concerned about these issues where they're existential, when there's therefore alignment with our financial interests, then are we always going to be playing catch up? Now, we do know what those last 2 points in terms of harms that are caused which are not existential or that are successfully externalized by companies. And this is Terry Smith from one of the UK's largest fund managers, Fundsmith, talking about Philip Morris. So let's hear from Terry.
This has led to two things which have been hugely beneficial to their financial status, their operations, their returns, their profits, their cash flows, and to us as shareholders. And those are, one, these are industries which have got fabulous returns on capital. You know, in the end, they're basically selling an addictive product. Right? So they've got this wonderful business with these fabulous returns and this #1 brand, and they can't spend any money on advertising, marketing, or now packaging.
Fantastic.
What's not to like?
Yep.
And then, I mean, the government's intervention is, I mean, we are very, very inclined to invest in things that the government thinks is a bad idea, and they'll try and stop.
So that's quite an extreme example, I guess, but this is a pure focus on risk and return. The social and environmental issues associated with the tobacco industry are not a consideration there whatsoever. So I'm going to hand over to Abby now, who is going to talk about some of the behavioural and other challenges which are potentially holding us back in this regard. So over to you, Abby.
Thanks, Pablo. Good morning to those of you in the UK, and thanks for joining us. Yeah, thanks. I was just going to say the presentation disappeared, but it's back. So as Pablo mentioned at the beginning, I'm from the Monash Sustainable Development Institute, and I'm part of a team of behavioral scientists there in a unit called Behaviour Works, where we try to use behavioral insights to try and solve behavioral aspects of social and environmental problems. And in thinking about some of the things that enable the attitudes that we've been talking about today, we found it helpful to sort of think about 3 different facets of the barriers to making sustainable investment the default. And we kind of thought of those in terms of the system, the social, and the individual. So part of the systemic issues are things like this narrow focus on risk and return and some of the classic financial modeling and the benchmarks that Pablo discussed and that we'll discuss more. And also the kind of short-term timeframes in which performance is measured, as well as systems of education that bring up what are considered to be the relevant competencies for people coming through the industry and sort of filter through into the social. So aspects that you'll often hear in terms of the behavioral biases like herding and the ways in which often decision and even risk appraisal seem to happen very collectively and are highly influenced by social environments, as well as things like the lack of diversity, some of which seem to be on display in that panel you just showed us, and also aspects of corporate culture and what kinds of performance is considered to be most important, and also just some of the cultural and attitudinal norms. And then, of course, on the individual level, some of the things that can be drivers or barriers for sustainable investing are things like what the career ramifications are perceived to be, what the incentive structures are within these institutions, as well as some of the biases and also the mindsets and the values and assumptions that underpin the way that people make their decisions. And as we talk further, we'll think about the ways in which identifying some of these things might also present levers for change inside of these organizations and the finance sector. And I'll hand over to you, Pablo.
Thanks, Abby. And we're going to hear a lot more from Abby shortly. So let's look again at some of the ways that these behavioural beliefs issues can then manifest themselves. So we're going to hear from Larry Fink again. This time, it's not a continuous piece of footage. I've taken out most of the times when he's expressed a belief around how investing around climate change will be beneficial for returns. And then at the end, the journalist Andrew Sorkin asked him a question of whether it will become the standard. Will we see on the news the sustainable index rather than the Dow Jones or the S&P 500? So let's hear from Larry here.
I believe we are just beginning a major reallocation of capital. How they're performing, and I truly believe the purposeful companies that I write about for the last few years are going to be the companies that are focusing not only on their stakeholders, but they're going to be focusing on the long-term impact on climate change and how it impacts their company. Talking about as a long-term trend that is going to have a remarkable impact on valuations of companies, valuations of industries, and we believe there are going to be some industries that are going to be better prepared. Some companies in the energy mix will be better prepared, and those are the type of companies we're going to be investing in. So we are saying here, we believe under ERISA and maximization of return, we believe a portfolio that focuses on sustainability and climate change will be a portfolio that outperforms. So the main, I believe a climate-centric fund, like a climate-centric target date fund, will outperform a typical target date fund. And I would, maybe this is a big short if I make this statement, but I'm willing to do it. Andrew, I believe in 5 years, every investment will at least have a sustainability lens. I have to tell them it's not my money. And we're doing everything we can to provide a sustainability lens, better analytics. We're going to show them, and we do believe they're going to outperform. And I do believe over time we're going to see this transformation.
It may become the standard.
I would hope, maybe it's not in 5 years, but maybe in 10 years, there's going to be the S&P or the MSCI index that has a whole sustainability lens. As I said to you, we believe sustainability will be investing across all different products. And so, but can I tell you will be the core product that we're going to be looking at will be a sustainability ticker? I don't know. There's so much embedded money in the S&P and the MSCI, world index.
When it comes,
I find that I think is really fascinating because I think that there is clearly, I don't doubt in any respect Larry Fink's commitment around the issue or his belief that investing sustainably will ultimately lead to better returns. But it's fascinating to see that he couldn't quite then see the entire system changing. And if the system doesn't change, are we going to deliver on the outcomes that we need to deliver on in order to achieve the goals that we need to get to? Now, there are some really strange things that happen then in markets. Now, I'm not going to attribute this all to behavioural biases, but Deutsche Bank Research did a fascinating piece where they looked at companies who had really positive climate change news over a preceding 12-month period and those that had really negative climate change related news over that preceding 12-month period. And they found, as many of us in the industry would not be surprised to see, that those with poor climate change news underperformed. The really interesting thing, though, is that it was at the times of crisis, and it doesn't go as far as to capture COVID, so it'd be interesting to get them to cast this forward a little bit to capture 2020. Every crisis since the global financial crisis is actually when the negative climate assets have performed best. And so like a fascinating disconnect. And the question I think that ought to be asked is, does this behaviour, this market behaviour, sow the seeds for the next crisis in our response to a current one? Now, I'm going to switch gears a little bit and leave that performance and beliefs around the system change to one side and talk about the very noble goal that both Larry and David expressed, one that I believe in very strongly myself as well, is that these assets that we're managing are not our money. We do need to manage them in the best interests of those savers who have trusted us with their capital, and try and unpick that a little bit, because I believe that there is also a disconnect between what is expected of us by society and what we think is expected of us by society. But first, let's hear from Larry talking about protesters at the front of the Blackrock building.
How much of it, though, was also the public pressure? There have been protests physically outside this building.
Yeah, with my picture on it.
With your picture on
Yes.
it. There have been letters sent from people talking about the destruction of the Amazon, from people talking about the destruction in Australia.
Yes.
How much of that has weighed on you?
Very little. But they serve a purpose. I'm not here to say they're not, I do believe in freedom in speech. I have to be motivated by what I think my clients need. And so everything I focus on is the needs of our clients. And it was my client's inquiry, as I discussed with you earlier, it was my client's inquiry that really became the eye-opener to me. I'm not trying to say they were not on my conscience, because, of course, I don't like walking into my building and being protested and everyone saying, oh, there's Larry. And, it's an uncomfortable feeling. But but that was not as a fiduciary to our clients' money. that was not a meaningful component of my thought process.
And as I said, I completely agree with that fiduciary responsibility to client assets, and also believe that people like Larry Fink and David Neal believe that very strongly too. My question then becomes, what is the nature of client interest given the environment that we are in today, as we saw before in terms of the Global Footprint Network chart, in terms of the economic positioning, in terms of the Sustainable Development Goals agreed by all countries for us to achieve by 2030. So let's look at this now. Again, this is Australia-centric. I do apologise. I've not seen this question asked in this way anywhere else, and I would love to see more of it, because unlike what's typically asked in surveys like this, where people are asked, would you switch your money to more sustainable investments? Do you want your investments to be sustainable? And of course, most people say, yes, I do. This is actually, but it requires a decision, a switching decision, right? And what we're really interested in today is the system and the default as being sustainable. And so this RIA survey asked what they expect their current super fund and banks to be doing, and overwhelmingly 86% of people in Australia at least are looking for their pension schemes and their banks to invest responsibly and ethically. Interestingly, also when you think about adequacy in retirement, and I know in the UK there's been more of a DB pension system for a long time, moving more to defined contribution now, but people in terms of retirement adequacy are likely to save more if they believe that their investments are having a positive impact. So really a double benefit there. Another interesting insight from RIA's benchmarking work is what people expect when they talk about managing their funds ethically and responsibly. And so here in the green bars, we have what people have asked for in terms of things that they don't want to be invested in or screened out in the responsible returns tool that RIA runs. And then the blue bars are what fund managers who use screening, not necessarily for specific funds, some of them use it across their entire business, what they're screening out. And overwhelmingly, fund managers are mostly armaments and tobacco and fossil fuels being the three. But when you look at the disconnect between fossil fuels, which is almost double in terms of what the consumers are asking for versus what is being screened, and human rights abuses is 3 times the level, animal cruelty, logging not even on the radar of fund managers. There is a serious seems to be a serious disconnect there. Now, what's most interesting here in terms of Larry Fink's video is that we saw before his view that he needed to really focus on his clients and his clients' interest. But here we're going to hear from him talk about what it means for the companies that he's investing in. So slightly different perspective.
Look, so what are you going to do if there is a company with a management team that appears on the surface to be doing a tremendous job in terms of the earnings and the growth of the company and the stock of the company, and yet their sustainability plans are not on par with what you would think? Are you going to vote against them?
Well, I'm not the one who's voting, but I think we would be posing some questions to them. And my long-term view is it will be harder for that company to outperform over a long period of time if they're not addressing some of these society's issues. These are not Blackrock's issues. These are society's issues. And what I'm saying is more and more in society are raising these issues. So for a company to be totally negligent on those issues and have great results, I'm going to find it hard to believe that the inconsistency of that. I do believe companies who are focusing on society's desires and needs are going to be those companies that have better outcomes financially. And I do believe those companies are going to have better long-term profitability.
It's interesting, isn't it? I find that really fascinating. And as I mentioned, I in no way think that I think he absolutely believes he's doing the right thing. I'm sure of that. I'm sure he thinks climate change is a very serious issue, but it is fascinating to see how he sees his role and the role of Blackrock as a fiduciary versus the roles of companies and company directors, presumably, in terms of their duties and their responsiveness to society's challenges. We're going to look at just one more example. So I've given you a couple of different examples in terms of the ways that these types of mindsets and beliefs manifest themselves in some investment outcomes and some investment approaches which don't line up with the goals of the Paris Agreement, of the Sustainable Development Goals. We're going to look at another clip here from David Neal talking about exclusion as a strategy. So we talked a little bit about screening in a previous slide.
Last year, while you were heading the Future Fund, you rejected suggestions that the fund should divest itself of fossil fuel investments. Your view then that the fund had a mandate to maximise returns only. Do you bring the same view to IFM?
I do. I mean, that's the point I've just made, is that I don't believe exclusion. I think exclusion is way too blunt a tool, and I think in some ways it could be counterproductive, because these assets end up in the hands of people who perhaps don't have the same intent to want to reduce emissions. Whereas what we're about is understanding the risks that climate brings to those assets, understanding the emissions that those assets have, and doing what we can to reduce them.
So a financial argument again, and I think this brings us back to some of the discussion we were having earlier around benchmarks and because of course fossil fuels haven't been a great investment, certainly over the last decade. We have the 10-year performance of global oil and gas companies here. You actually, I ran this chart a little while ago. That number's now, I think, 11% per annum losses over the last decade. I should really update it. But in any case, not a great investment. Coal is even worse. The production estimates going forward, so if you're thinking about investing as a reflection of future cash flows, by and large, according to their own estimates, oil companies are seeking to produce more hydrocarbon fuels than what they are today over that 10-year view. And so there has to be some serious questions asked about whether they're appropriate investments at all. And but maybe there are, and certainly there are cases of engagement where companies are able and willing to change. But I think taking divestment off the table on a financial ground is perhaps looking at these types of assets through a risk lens which is based more on benchmarks and thinking about risk in that respect than it is about the real risk that sits within these assets. And here is a reflection of that. So that in 2009, the 10 largest companies globally, 4 of them were fossil fuel companies, 2 being the largest companies in the world at that time. So if you're an investor and you're particularly concerned with benchmark relative returns, you have to have a strong conviction if you're not going to be investing in the PetroChinas and the Exxons, because they comprise a not insubstantial amount of the benchmark. Fast forward, of course, that's not the case, and it's filled with technology companies today. But there's a clear lesson, I think, in that in terms of the way that we think about risk as an industry, and particularly over the timeframes which we're often comparing ourselves to benchmarks being quite short, often quarterly. Then, of course, you'd think perhaps we would have learnt as an industry. And I personally, I find this one perhaps the most bizarre example to date. Saudi Aramco, many of you will know, it's the largest oil company in the world, listed recently, issued a bond last year to raise, I think it was around $12 billion, $100 billion oversubscribed. The bond issuance was. Fast forward to 2020, and something even more fascinating, there is a 50-year tranche. So investors in this bond, which was also, according to the analysts, significantly oversubscribed, is relying on Saudi Aramco to still be a profitable going concern in 50 years' time. It's a bold bet, really, if you're looking at climate change and the urgency with which we need to reduce emissions. And we really need to put that emissions reductions demand in context there as well, because to give you some kind of comparator, during the course of 2020, with the global pandemic, the complete shutdown of travel, the loss of millions of jobs, economic recession globally, we've emitted around 6 to 7% less than what we did in 2019. Now, in order to stay on track for a 1.5 to 2 degree outcome, we need to continue to reduce emissions 6 to 7% a year, every year, at least out to 2030, and from there it probably needs to accelerate. And so these types of investments, really you have to ask in terms of a 1.5, 2 degree outcome, rather than talking about net zero out to 2050, they're a much more immediate concern, because we need to make those reductions, of course, without blowing up the world economy or shutting down the world economy. This one is just a curiosity to me. It's a superannuation fund in Australia. I haven't named them there, but it's a list of their investment options and how they've performed. And global environmental opportunities is off the chart, but obviously very concentrated, fairly high risk. Sustainable high growth performing better than the high growth. The sustainable balance performing better than the balance. Now, that's not true over all time periods. Clearly, it's just a recent phenomenon. We're looking at their long-term returns, and I'm sure when you look at that list of performers, you're probably like me, imagining people ringing up their pension fund saying, I want lower returns, and I don't care who you have to hurt to get them. No one's actually saying that, I'm sure. So how are these then presented, these different options? So you've got sustainable high growth and high growth. And the responsible investment options for this fund actually show a caveat there around the investment credentials of those funds and the need to still maintain investment returns as a top priority when investing responsibly. And I think a lot of the messaging that we send out as an industry, because sustainability isn't the standard, because sustainability isn't the base case, we wind up seeing or inferring or sending a signal that sustainable investment is somehow higher risk, inferior, potentially doesn't have all of the attributes of broad-based investment. And I think, again, part of that goes back to finance theory and the way that we think about our role. So I am now, without further ado, going to hand back to Abby, and she's going to talk us through not just what sits behind some of these really interesting happenings in the world of investors and financial markets, but also some of the ways that we might counteract them and seek to resolve them. So back to you, Abby.
Thanks, Pablo. In thinking about behavior change or thinking about these kind of systems changes that Pablo's been talking about, I guess it's worth maybe articulating that we see behavior change and systems change as really interconnected, that systems are made up of people who make choices and decisions and also are embedded within systems that, of course, are shaping the decisions that are available to them and how they think about and approach these. So sort of with that in mind and thinking about this kind of iceberg schema, this idea that what we are seeing in terms of behavior is just what is visible, and underneath that are lots of thoughts, beliefs, and values, and that these kind of comprise the mindsets. And in these kind of schemas, usually the bottom strata is considered to be the most influential, but of course that's also considered to be the more difficult things to change. Changing values and beliefs are pretty foundational to how people are approaching things. And so with that in mind, we wanted, as Pablo said, to kind of shift in toward the end and thinking about what some of the solutions to these things might be. And some of the work we found quite interesting. The work of one of our collaborators, Danielle Gayet, has been really interesting in this regard in terms of thinking about how you could shift mindsets within the financial sector. And many of you are probably familiar already with the terms of fixed mindset and growth mindset. And the concepts have been modified slightly in this context to really differentiate between the idea of a system in which you tinker and potentially play around the edges of that system versus the growth mindset, in which there is a little bit more fluidity in thinking about decisions with more expansive concepts. So the system itself becomes one of the possible levers of change. And to that, the work has introduced this idea of the sustainable mindset, which is really trying to articulate the ways that the goals of risk and return are really interconnected with these positive real world outcomes that Pablo's been describing before. And some of the work has been engaging with companies to try and see how you can increase the prevalence of this sustainable mindset. And next slide, please. Of course, in trying to encourage that shift, there becomes the difficult question of how do you tell when new mindsets are taking shape within an industry? And part of the reason we found Danielle's work really interesting is because it's trying to articulate the aspects of that sustainable mindset that you might be able to benchmark and then track improvements or changes along those. And she's identified 5 key concepts that are components of that mindset. And there's this systems thinking, so the willingness to take this kind of big picture framing, and the appetite for change, which is also pretty connected to that fear of failure. So the appetite for change being a willingness to change or to challenge the status quo. Also an openness to learn, and again, in thinking about how you might mitigate things like the institutional arrangements we mentioned before, where education might be primarily preferencing certain kinds of skills and concepts. This kind of openness to learn also allows for many different stages of introducing new values, concepts. And finally, that collaborativeness, maybe partly in reflection of what we were talking about before with what Larry Fink was getting at about society's issues. Perhaps that ought to also apply to the financial sector in terms of thinking more collectively and collaboratively, both within organizations and between them, and maybe even to social impact. Next slide, please. Of course, when thinking about systems change, it's really difficult to start to think about how you can evaluate what you're doing. Certainly in our behavior change group, it's hard enough to measure changes in behavior, but even more to try and think about behavioral interventions that are hopefully shifting a system toward what you want. And we found these 5 categories of questions to be really helpful in trying to measure impact in shifting systems. So first, this discursive element, whether stakeholders that you're working with are changing the way that they talk and the sort of references they make to different kinds of values. Relational, and that's often on the organizational level, like where you're seeing the collaborations between different kinds of organizations and where you might see a change in some of those, maybe a cutting off of certain kinds of relationships. The material and the resources, probably to many of you who engage with companies, like this is one of the primary ways of making sure that the resourcing is also matching some of those discursive and relational changes that you might be seeing, and seeing real differences in allocation and stopping certain kinds of projects and investing in other kinds of projects. And then institutional, some of the institutional arrangements also shifting toward a different kind of system. And next slide. And yeah, in conclusion, in terms of trying to articulate what the kind of system is that we're talking about, Pablo talked before about the way that the risk and return anchor can be quite limiting in terms of what we see as possible. But really moving this anchor toward seeing risk, return, and real world impact as interconnected in a pretty integral way is a way of expanding the view of finance to really activate its ability to be one of the key levers in helping us transition. And helping us to achieve things like the Sustainable Development Goals. So thank you very much for your time, and we would love to have a virtual version of the conversation with you. So if we'd love to hear your own experiences of mindsets and cultures that you've encountered, as well as any questions that you might have. Thank you.
Thanks, Abby, and thank you all for listening. We do have one question from Neil Campbell, which but please do ask others. I'll come to Neil's in a second. I just also wanted to make a brief closing remark. So Altiorem, as I mentioned, was established to provide people information to support them in making the case for change and implementing those changes, and we've organised the library as such to do that. But one of the things that we're really interested in, and the reason that we just wanted to do the presentation that we've done tonight is, or this morning for all of you, is that information on its own is not enough. And I think we have a lot of discussion across the industry around the TCFD, improving company disclosure, and all of those things are important, but they dominate in a way that doesn't actually reflect, in my view at least, where a lot of the real challenges lies, and that's in shifting our mindset. And so I really believe that by the first step of any problem is to recognize that you have a problem, and as in an industry, we really need to start thinking about how we bring real world impact into that discussion and put it on par with risk and return in the future. So Neil's question, thank you Neil, is I'm a NED in a small investment manager. Do you see the change towards sustainability coming mainly from board influence or from consumer pressure? Thanks Neil. This is, so the way that we've organized actually the Altiorem library, and I mentioned the ethical case, the business case, the investment case, and the economic case for change. And so in terms of the business case, the way that works is related to what's in the interest of the organization itself. Why is it good for the organization to do this? And we found a number of areas, but the main ones are that it comes from consumer demand. So that's clearly a big driver, and we're seeing that in all markets around the world where consumers are calling for it. And certainly we heard from Larry Fink earlier in his interview that Blackrock's responding by more products and a whole range of other initiatives, as is much of the industry. There's competitive pressures, because if your competitor is doing more on sustainable investment, then you're at a competitive disadvantage. There's the regulatory push, and of course all of you there in Europe are trying to work through the implications of things like SFDR and the taxonomy, sustainable finance roadmaps, and so on. We have in Australia regulatory pressure as well from APRA and ASIC, who are our corporate regulator and our prudential regulators, looking for us to incorporate climate risks. And then it also comes from other ancillary drivers like cost benefits and whatnot. What we try to do in constructing the library is to tag research so that you can make the case based on whatever it is that you think is going to be most relevant to the conversation you're having. And so if you're speaking to a chief investment officer and you want to talk about the investment case, risk return, other types of impacts, there's content there. If you're looking at the business case and what the role of directors are in their resources, then there's information there as well. So another question from Neil. Are the resources and slides available to help us with our efforts to influence our peers and colleagues? Oh yes, so Altiorem is free and open access to everybody. We're a not-for-profit, so you can sign up at altiorem.org to become a member, and we're continuously growing the library. The model that we have is one, it's unique, a bit Wikipedia-like, I guess, in that we have university students like those at Monash University in Melbourne who volunteer their time to summarise research, because we're all time poor as well, of course, and reading 100-page documents is a struggle at the best of times. So they summarise the report, they categorise it, they pull out the best charts, the best quotes, and they link back to the original content so that you can then have good access to that, to those resources. And then the other aspect, of course, is that we have mentors who are industry experts and issue experts who ensure that the resources meet a very high standard, so they're reliable. Looks like we have another question here from Dr. Godson. Do you consider lack of political will as a major constraint to a change in mindset? I might go to you for this, Abby.
Yeah, thank you for the question. I would be interested in your view on this too, Pablo, but it does seem like there are interesting dynamics around the way that political will influences the kind of industry mindsets that happen. So full disclosure, finance is not the sector that I work in most often, but I've been doing a lot of work recently in hydrogen sector, which in Australia has quite a lot of natural gas companies that are really interested in investing. And it's been interesting to think about the ways in which some of the policy settings and the political will behind things can feel like a competitive disadvantage to private companies who are eager to sort of anticipate a transition that they see coming. So certainly I think that there are ways that political will does influence what the sort of organizational culture norms and the system settings are. But at the same time, I think there are lots of cases in which industry is leading things, both because of this sort of direct line to the consumer demand that we were just discussing before, as well as ways that international markets mean that even when domestic markets have a lack of political will, that there can be anticipation of the ways that system or regulatory changes are likely to come through. But certainly it does seem like the lack of political will slows down that process, even though I think there still are opportunities for industry to lead that, even in the absence of political consensus or leadership. Pablo, I don't know what you think about that.
I think I agree with you, Abby, and I just add that in Australia, I mean, we look at your in the UK, the recent very ambitious 2030 reset targets there that have been announced by the conservative side of your politics, whereas in Australia we still don't have a climate policy at all of much substance. And I think that it's true for a large degree that there is a concern around the political will, but then in the last few years, and I think that it's almost as though it's like an elastic band that it can be stretched to breaking point and then it snaps. And so the clear impacts of climate, we had terrible bushfires last year, record temperatures over a number of years, really intense storms, extraordinary conditions, unprecedented droughts. And the investment community and the regulatory community, even outside of the political sphere, have really stepped up in terms of climate. And you've seen other levers being pulled, like the legal system, for instance. So we recently actually had a member of a superannuation fund, Rest in Australia, sue their fund for not doing enough to describe the way they're dealing with climate risk. And they wound up settling, and Rest has subsequently made a net zero to 2050 commitment. So I think, yes, it's certainly like a whole range of other constraints that exist. It can be a constraint, but it doesn't need to be determinative either. And actually the US is another good example of this, where at the federal level, there's not been a lot of political leadership around climate, but at state levels, there's been a lot more. And you're still seeing extraordinary action on the ground in that country as renewables have exploded across the US. It looks like we've run out of questions, Abby. So we might just give you one more moment to ask any final questions, and while we're doing that, we can just say thank you to you for listening and to staying with us to this point. We hope you enjoy the rest of the conference. We know you've got some wonderful speakers ahead. We're extremely grateful to the Accounting for Sustainability program for inviting us to join and be part of this fantastic event. We hope it's been informative. Please do get in touch with us if you'd like to know more about behavioural shifts and mindsets. And I also really want to endorse the work of Danielle Guy. As Abby mentioned before, she's really unique in the work that she's doing to explore the mindsets of boards of superannuation trustees, boards of investment organisations, and really trying to pick apart as to how firstly you can set a baseline and then measure change over time. So I think she's doing wonderful work, and thoroughly endorse her work. So with all of that, thank you for your time and enjoy the rest of the conference. We're really grateful for you taking the time to join us today.
Thank you very much.